I'm going to go off script a little. And I'm going off script a little because I've had a really interesting experience over the last 6 weeks. I've been asked to speak twice in the last 3 weeks, and in the run-up to the speaking or the opportunity, God did some things in my life that changed my perspective, and I had to redo what I was going to say. And being here and experiencing the people, your culture, the space, and then reflecting on what Africa has been blessed with and Rwanda has been blessed with, I think we're missing something. Because we're talking about all the natural resources we have. We're talking about the youth population we have. But the gift that we were actually given, and it's a double-edged sword, we see it as a negative thing, but it's actually a positive thing. Our modernization was delayed. And that's actually incredibly powerful if you think about that. Because the experiment on what a flourishing life in the West looks like is done. It is horrific. And if we had chased after that prematurely without realizing what the results would have been, we would have been in the same mess. To some extent, the delay is the gift. And now we can look around the world and say, they said we must do this. What are the results on the population? And please do not copy a lot of what South Africa has done. So as I go into my presentation, specifically on the debt industry, I'm here to tell you how broken it is. And if you can start off and build your debt industry in a different way, it will be a flourishing tool for your population. Instead of what it's done to our population, it has enslaved them. And the situation is not getting any better. Okay? So don't look down on us ourselves because we haven't modernized yet. Actually, that's a gift from God to take it slow, to really observe the results, and to be wise about who we are adopting from. Great, so I spent 2015 to 2020 building a business that wanted to solve for the debt crisis amongst farm workers in South Africa. Well, an interesting journey. I've never dealt with farm workers before. And what I uncovered and what my business uncovered, or the business I worked in uncovered, was a very complex set of systems that were keeping our people enslaved to debt. There is no silver bullet. It was layer upon layer that was creating a mess for our disadvantaged. We are one of the worst borrowers in the world, and we are one of the worst savers in the world. Okay, so that is our result. I'm going to tell you how we designed a system intentionally to do that. And this is important because we need to take more time in the design of something. If I look at a design, can you figure out, before you put it into practice, what the results are going to be? And in another presentation I did to farmers specifically, because they're my clients, the presentation was called How to Farm Poor Financial Health. How to farm poor financial health. How do you create a system that is guaranteed to create poor financial health? And so this is how South Africa did it. Okay, so the first thing, coming off of apartheid, there was a great pressure on the government to produce results on improving living standards. Okay, they want to show that this thing is working. Unfortunately, they turned to the credit market for that. They were chasing after metrics, living standard measures in our country, and it's a tick box exercise. Do you have this? Do you have that? Now, they didn't want to wait for jobs, savings, general quality of life improvements to produce that. So they went to the credit market and they said, it's a free-for-all. You can lend to whoever you want to. And of course, if you're borrowing money to buy a TV and all of those things, you get the TV, box is ticked, washing machine is ticked, but no one's really looking at measuring the balance sheet. The balance sheet is impaired. Huge amounts of debt, no savings, but yes, you've got these things in your house. So that was the first mistake that we made. So I want to start by kind of reinforcing that lending is actually a very powerful tool. So if you think of how trade works as we engage with each other, and bartering was great, but it makes it very difficult for us to grow as a group of people, because the calculations for how many chickens is one loaf worth becomes difficult. So pricing is a really good thing. Currency is a really good thing. But as you exchange value, what will immediately happen is that there will be a surplus of value. So someone will sit on more money being earned than other people, right? And so the mechanism for distributing that surplus is very powerful in economy. So lending, investments, and insurance are very powerful financial products and services that can help create a flourishing life. And I mean, you can imagine if you didn't have insurance, you'd be a lot more fearful in pursuing whatever you want to pursue, whether it's in business or in your personal life. If you didn't have medical aid or medical insurance, a lot of us would be actually a lot more fearful because we would fear the consequences of not having financial protection if our health was impaired. So they've been fantastic tools. Even interest. I don't know if your culture has this, but in South Africa, like the concept of interest is looked at very negatively because it's been used poorly. It's been used as an extortionary practice. But interest is a very interesting tool for saying you have to be productive with your capital. Because you can imagine if interest wasn't there, there would be no reason to use that capital for productive means. You would just squander it. But now again, interest as a good tool can also be used as a bad tool. It can keep people enslaved to repayments for the rest of their life. So I want to start off by saying all of these things, let's not confuse the original good that could have been derived from the tools and mistake it for how humans with a sinful heart have used the tooling in a way to extort others. Okay, so that's the design. Now, how has distortion happened? Now, when Ofense was talking about the impact of sin, actually go to Genesis 3, 3 types of fallout are described. The painful toil, sweat of your brow, and thorns and thistles. And my focus on distortion, I want to focus on thorns and thistles. And for me, thorns and thistles is unintended secondary consequences. You had all the right motivation when you designed whatever. But because of a sinful heart on the consumer or the regulator, or whatever is the case, you end up with a horrific set of secondary consequences that you never imagined could happen. So I'm going to go through some of those that I've observed in the South African debt industry. We have made savings much harder to do in South Africa than borrowing. Our obsession by the financial regulator, we've split them. The savings regulator is actually distinct from the credit regulator. The savings regulator has been so obsessed with preventing loss of funds, it's actually made it increasingly more and more difficult for people to start saving. A unit trust in our country, so where you save into the stock market, up until a couple of years ago, the forms that you had to submit, the documentation you had to submit, the minimum contribution you had to start off with made it impossible for a farm worker to start. So in our country, it's 500 Rand a month. And up until a couple of years ago, our minimum wage was 3,000 Rand a month. Who of you can start off by saying you have to start saving 17%, otherwise you can't save? Again, this unintended consequences of trying to protect the saver has led to secondary consequences which make it more and more difficult for people to start saving. Education. Now, we live in a Western environment. We often look to education, knowledge as the reason why people aren't doing things, right? Financial literacy in the financial space. And what's happened in our country is we've said that adults are adults. As long as we can educate them, we are going to trust that they make the right decision. That works when everyone is equally yoked. But when a big part of your population can't read, have never had formal education, and it's an open market for the type of financial products and services you provide, what I mean with that is, there are products available to our blue-collar workers in South Africa today that if they engage with them, it will decimate their life. And the way the industry has responded is, as long as I educate you, like I'm going to trust that you're going to stay away from those products. My response is, like, you don't leave your gun lying around with a 3-year-old in the house. You don't give wine to a 4-year-old. And I'm not trying to be derogatory, that is just the truth of the matter. Why can't we, to protect our vulnerable, say there are certain minimum criteria for how lending is done, and to protect them? And as you become more mature, you can access more powerful weapons. Unintended consequence there is we've let a blue-collar worker who may have never received a primary, they've gotten to grade 7 education, in the worst education system in the continent, to compete against Ivy League level economists and actuaries that work at a company. Is that fair? with all the understanding of how human behaviors work and incentives work and the marketing power, that versus someone who's highly uneducated, and we've said that's a free market mechanism. Is that fair for our disadvantage? And of course it isn't, because the results show our people are seriously over-indebted. The business model. Like most of us, when we appoint salespeople, we think commission is a healthy way of remunerating our people, right? I mean, they need to show results, and in return for the result, they need to be rewarded. But what happens when your business model is based on loans, and the only thing you sell is loans, and the only way you get richer is if you sell more debt? What's the secondary consequence of that on the ground? Think about that for a second. And that's what we have in South Africa. And the people that become desperate, and this is the worst part of war, you're asking them to make a decision between putting food on my family's table versus maybe pushing a little bit too hard and getting that loan done. How is that a just area of work for our staff? And then lastly, probably the most perverse of all, our credit bureau. I'm not sure if, I was speaking to the lady from Burundi yesterday, and they've got a credit bureau. I'm not sure if Rwanda does, but the purpose of the credit bureau is to aggregate all of credit data in one place so that I can't just go and borrow money from there and there and there and there, and they don't really know if I've got anywhere else. It's basically to protect the ability to afford a loan, right? So if I've got 100 Rand repayment there, the next credit provider needs to see it, because I can obviously lie on what my expenses is, so they can not issue the same amount of debt. The unintended consequence of that, in a country like South Africa, if you're hungry to issue loans, when someone writes the income and expenditure, you don't question it, right? If they say, I only live off of 50 Rand of food, doesn't matter. It's just more income that I can issue to, right? So you're not going to double check that. What's happening is, what they can't ignore is on the credit bureau data. Because if the credit regulator checks up on them, the person can say, but they told me they lived off of 50 Rand. And I can say, yeah, but okay, they lied, it's on them. But if they go and check what was on the credit bureau at that time, and it was clear that you ignored them, you're faced with penalties. The unintended secondary consequence of that is it's become a competitive moat. Credit providers are pushing to keep credit levels high so other competitors cannot get their credit in to the consumer. Does that make sense? There is no incentive from a credit provider to reduce the amount of debt outstanding for any specific consumer. And we actually saw that in practice. The clients that we had that had debt elsewhere, all of their debt elsewhere, their average debt increased over time. So every time they get a salary increase, and especially if you were the bank, they could see that, and then they send out an offer for more debt. Every time when the loan is about to finish, they send you out the offer for more debt. With our clients, the average debt slowed down over time because you're paying it back, right? And so you can actually see it in the results. And this was over 7 months. So it's not a long time for the effect of this competitive behavior in the wrong way to come out. And so, yeah, we are still on a journey. But here are some of the practices that we have put into place to take into account the distortion in the market. So firstly, when you borrow from us, we've realized you can't split lending from savings. If you borrow from us, you have to save with us. And there's certain minimums attached to it. So we're asking you to eat your broccoli while you have chocolate. We're not going to just let you have chocolate. Okay? Within that, what we did was we hid broccoli in the chocolate. And this is another fallacy in the market. We thought when we started off, low-cost loans is going to save the nation. Do you know what the guys did? They borrowed more money. We assumed that they would use this savings and disposable income to save, but they just took out bigger loans. So what we realized is we actually have to squeeze disposable income, meaning we can't trust them with the disposable income. So we increased our fees again. But the fees we give back to them as savings right at the end when they pay off the loan. Okay, so we're hiding broccoli into the chocolate. Then additionally, we had much stricter affordability criteria. So the lady from Burundi again, in South Africa, what's interesting is the way we assess debt provision or giving debt to a company is different from the way we give debt to an individual. And the key difference is whether we assess the balance sheet or not. So for a company, if you're borrowing lending to a company, you look at the balance sheet, assets and liabilities. And you look at the income statement, whether or not they can repay the repayments. For consumers, we only look at income affordability, whether there's disposable income. Now the problem with that is a 60-year-old borrowing 4,000 Rand is in a very different place from a 25-year-old borrowing 6,000 Rand. And so we started saying, we're going to look at your savings, how much of your assets, before we determine how much you can borrow. And it must be linked some way. So if you only have a little savings with us, we're only going to lend you a little bit. But as you grow your savings, we can trust that we can give you a bit more money. And so those are some of the mechanisms that we started putting in. And there's a whole kind of essay around this that one day we'll write. But of course, we needed technology to be able to do this, right? We can't do this manually in the background. So we had to build our own technology from the ground up that supported this way of thinking, because all the other technology that we could buy from the market supported the other way of thinking. It was actually impossible to offer this value proposition to the market without building our own technology. And we're not yet there. Our vision isn't yet fulfilled. There's much more that we believe we can still do. But it's a journey to say, we know what is right. We are taking the next step. We're comfortable with the dirtiness of where we are, because if we're not going to figure it out, no one else is. And so again, whoever's in the room that can speak to policymakers about debt, please look at South Africa as a case study of what not to do to your people. Our mission here as Africans isn't to export our minerals. It's not to export value-added goods and services. It's not to export our intellectual capacity. It's to export a new way of doing life. We want to show the world this is the life. This is the way that God intended life to happen. This is the way that the economy is supposed to work. This is the way the justice system is to work. That is the best export we could do for the rest of the country. Yes, all those products and services, that's great, but it must build up towards this is the way in which the products and services were created. So let's aim for that, not just for exporting more minerals or coffee beans or whatever is the case. Because the world desperately needs that more than it needs our coffee beans.